Hey everyone, welcome back to Corporate Decoder, the place where we dig through the corporate filings so you don't have to. Today, we're cracking open Granite Point Mortgage Trust's latest 10K, and let me tell you, this one's a bit of a roller coaster. We're going to find out if they can keep up while the interest rates are high, and I am not just talking about your credit card bill. This report, it's a mixed bag of news. Some wins, some struggles, and a whole lot of details we need to unpack to figure out what's really going on with this mortgage REIT. So what's the big picture? Granite Point, they are in the business of lending money, specifically commercial real estate. That means loans for office buildings, hotels, apartments. Think of them as the bank for big real estate projects. And as a REIT, real estate investment trust, they have to follow special rules, like paying out most of their profit as dividends. Their game plan is to focus on what they call senior floating rate commercial mortgage loans. Those are loans that adjust with the market. That strategy is intended to provide a cushion when inflation is rising and is normally considered lower risk. They give out what's called bridge or transitional financing, money that helps owners buy, fix up, or improve properties. Let's peek at their loan portfolio. As of the end of last year, they had 54 loans on the books totaling $2.1 billion. 97.9% of these loans are floating rate, which is key to understanding how they make money. The yields, the total return they are making on these loans, it's around roughly 4%. Where are these properties located? A big chunk, around 33%, is in the southeast, followed by the northeast. And what kind of buildings are we talking about? Over half the portfolio, 52%, is in office properties. Oh, they may be subject to higher risk of loss, keep that in mind. Another big piece, 30%, is in multifamily, so those are your apartments. Now, how do they pay for all this lending? Well, it's a mix of debt and equity. They've got credit lines, repurchase agreements, and these things called CRE close, commercial real estate collateralized loan obligations. Translation, they borrow money using their existing loans as collateral to finance new ones. As of the end of last year, they have potential borrowing of $1.3 billion for their loans. They like to keep their debt at around 3 to 3.5 times their equity. In other words, for every dollar they have in assets, they borrow $3 to $3.5, but they might change that depending on the market. So what could throw a wrench in the works? Turns out there is a laundry list of potential risks, from general political and economic conditions to rising interest rates, reduced demand for office space, remember that 52%, and even acts of war or terrorism, you name it, they have it listed. They also point out that the market is competitive. They are going up against other big players, some with deeper pockets or a higher risk tolerance. This competition can drive down the yields, the returns they get on their loans. Let's talk numbers, the financials. Net loss attributable to common stockholders. A whopping negative $221.5 million. Compare that to negative $77.6 million the previous year. Not great. Basic loss per share, negative $4.39. In contrast, dividends they declared just 30 cents per share. Now their book value, what they think each share is actually worth, is $8.47. That's inclusive of those credit loss reserves. And what's a credit loss reserve? It's like a rainy day fund for potential bad loans. They have to estimate how much of their loans might not get paid back. That number, it's up to $201 million. This means they are expecting some borrowers to have trouble paying. Also, what does all this mean? Well, they lost a lot more money last year than the previous year. Let's talk about the crew steering this ship. They have 33 employees, that's it. Granite Point is very focused on a positive work environment, diversity, ongoing professional development, employee wellness, and making sure they are paid competitively with good benefits. They are required to comply with certain provisions of the Equal Credit Opportunity Act that are applicable to commercial loans. They have to be fair about who they lend money to. Scroll election/non-numeric. Now, if they screw up and don't continue to qualify as a REIT, they are going to pay normal corporate income tax, and it will not be pretty. Let's just say that the rules are extremely complex to follow and very easy to screw up. Also, there are ownership restrictions on who can own the stock. The rules are complex, but essentially to maintain the REIT status, so there is no one individual who owns more than 9.8%. Basically, no hostile takeovers. One more important thing, cybersecurity. Like any financial company, they are a target. They have a plan, they do training, and they have insurance. But you can never be too careful. So let's put this all together. Granite Point Mortgage Trust operates in a tough sector, real estate, especially commercial real estate. They face many challenges, from increased interest rates to potential difficulty in finding people to take space in an office and potential cyber attacks. The big risk here is how these trends affect the folks borrowing from them. If their borrowers struggle, so does Granite Point. The financials, well, they are not looking great. Big loss last year, a rising rainy day fund for bad loans. They paint a clear picture. It's a time to be aware of the challenges in the office side of things and how well they can handle when their floating interest rates do not offset loan defaults. Despite what looks to be a challenging business environment, the overall team of Granite Point has stayed consistent at a relatively small team of 33 employees, so this might signal they are ready to face headwinds and adapt accordingly. But there is still some unsteadiness in the water. Thanks for watching. If you enjoyed this video, please subscribe, like, and comment.